Well, we might as well get started, seeing how you don't have a lot of time. We will have some general brief updates after the report. But overall, the crypto market saw a bit of uncertainty and consolidation the past month. Um, Along with that, we saw Matic be pretty underwhelming for the month of January. I think for the month of January, Matic dropped almost 20% in value from the beginning of the month to the end of the month. However, a vast majority of our fund is paired with Ethereum instead of Matic. So Ethereum, I kid you not. So Ethereum moved $600 in volatility from the beginning of the month to the end of the month. However, from the opening of the monthly candle to the close of the monthly candle, Ethereum moved 9 cents, literally 9 cents from when it opened on the 1st of January to when it ended at UTC midnight on the 31st. The price variance between those 31 days was 9 cents on Ethereum. So we got a whole lot of nothing. But with that, we were able to obviously generate revenue. So, all right, so let's get started. January, end of the month. So, if you recall, last month we did Q4 and December update. Obviously, moving into the next 2 months, we'll talk about individual months, and then at the end of March, we'll do a March Q1 update, kind of like we did for December. All right. Table of contents, you'll see all that later. And so the January summary, Michael, you want to kick us off?
Yeah, just kind of rehashing on what Patrick went over. We saw a lot of volatility come back into crypto, DeFi specifically. And almost all of that was driven by speculation over the Bitcoin spot ETF, and then obviously the launching of the ETF itself, despite the SEC's best efforts to deflate that balloon prior to it happening. But the funds really capitalized on the volatility. We're able to experience consistent and good numbers yield-wise. Last month, we did 6.6%. This month, we did 6.59% in yields. So, the strategy works. It's consistent. It's doing exactly what it needs to. And more so than that, what we were pleased to see was, despite the market looking at and experiencing a correction from the run-up that it had, we still outperformed comparative assets, that being ETH and Matic, which is exactly what this strategy that focuses on yield generation is supposed to do. It's supposed to hedge when the market goes down, and when the market goes up, we may not capitalize as if we were, 100% exposed to underlying assets, but we're earning yield whichever direction the market goes. And we're able to protect ourselves from some of the losses that may bleed off in a downturn just because of the way that we're positioned and oriented. So let's see. Anything else?
Yeah. So ultimately, the ETF was a sell the news event. We said it in December. It came to fruition in January. We'll see how much more that is true. I personally still believe we are in for some more pain when it comes to the market. I would love to be wrong. Now, don't get me wrong. I would love to be wrong, because if I'm wrong, that means the market goes up and everybody makes money. Great. However, anticipatory, there's not a lot of potential good news between now and the halving, while there is still plenty of potential bad news between now and the halving. So, all things being equal, Occam's razor, we ran hot for 4 or 5 months on the market, and markets always cycle. Now, if our cycle is down to the 38 it got to, I would be fine with that. However, there is a general sense among people who spend a lot of time trading or watching the markets that we do still have the potential to experience some more pain before the halving. And Q1 is a long period of time. So we'll see how February, March goes. If we have some more traditional market metrics come out that aren't so bullish, if the Fed chooses to pause rate cuts again next month, there's plenty of things and opportunities that could suppress any market positive sentiment over the next couple of months.
Yeah.
Right.
The other thing we're watching pretty closely is everything Ethereum has in the pipeline. I know we're kind of heading into an interesting period here with the Denkin upgrade, as well as you're
I just
starting
call it
to
the Duncan. I just call it Dunk.
Duncan,
I know it's
Denkin,
wrong. I know it's Dencun, but I
Dencun.
just say, yeah, it's Dencun, but I just call it Duncan because, like,
Ah,
the name
donuts,
Duncan makes more sense. Well, I wasn't thinking donuts for sure. Let's go the donut route.
coffee. Oh,
No, I just
but
like, you have a friend named Duncan. You're like, that asshole. Like,
what's the upgrade? But yeah,
what's
we
the
have
upgrade, Duncan?
the Denkin upgrade coming, as well as you're starting to see the hype and narrative build for ETH spot ETFs.
Hmm.
I know the first projection for that is people are looking at May as the first possibility for those to come through. So we're just keeping an eye on everything. Bitcoin itself is kind of in the middle of choosing what narrative it wants to buy into right now at this moment, and same thing with ETH. It's just kind of on the cusp of which direction it wants to go first. Ultimately, we think that it's probably going to go both ways. We're just waiting to see which one it wants to tap before it goes and taps the other.
Taparoo. Yeah, so that's kind of the general update for that. Our average return just on yield for the last 4 months is just shy of 7%. So that's a pretty good, like, consistent performance along the way. The Yeah, overall, like, we've been able to show consistent growth in obviously good markets. That's easy. This January, like this past month, to be able to show consistent growth and more sustainability. We didn't grow this past month, and we'll get into the numbers in a minute, but we did show that even in a contraction, we can be sustainable, and I think that's a really important part of the process. Yeah, so yield generation for the month, 6.59%, almost like almost identical to December, despite having distinctly different um, experiences within the market for the month. Our outcomes were almost identical. So we had $35,781 in total revenue for January. Michael, you have anything to add from a yield standpoint?
I just love the consistency. I mean, 0.01%. That's pretty great for a spread month to month.
Yeah,
But if
I
anything else, I like that it gives us an idea of a rough target in our heads of what we'd like to hit every month. 6% is kind of looking like that sweet spot in terms of a target. Obviously, we had a really great November where we shot way past that. But seeing month over month that the strategy itself is working, and not just working, but in a very consistent type of range, it's just a good validation that it's doing exactly what we want it to, and also just it gives us an idea of targets to hit.
right. Yeah, I mean, I would like to see, as more liquidity flows into blue chip DeFi, which we tend to spend more of our time in. Um, there's the general sense that we will have more months look like November than the last 2 months in October. But even still, anywhere between 6.5% to 9% a month, as we grow the underlying value of the assets, as we grow the positions in general, as we make adjustments, as the market evolves, this is something that they will start to compound on itself. And ultimately, as we take tokens off the market and destroy them, that value disparity between number of tokens and the size of the fund, it really starts to work in our favor as a protocol. So total generation since we started, 169. Where's my 69 crew at? $169,641. Nice. And then fund diversification. Obviously, you guys know we have about 20-ish positions. All of that is something that we have diversified enough to ensure that the capital is partitioned in a way that no one incident, because this is crypto, it is DeFi, nothing's 100% safe, but we try to make it as safe as possible. And so we try to put ourselves in a position where if one platform or one allocation were to have some sort of setback, it is something that is recoverable and able to be worked through. So that's important when it comes to the fund's overall diversification. Michael, go ahead.
As always, this is one of the slides. That's my favorite. It's overall efficiency to me is the way I look at it. The DeFi fund is 82% of the entire treasury value. And the rest of that is literally just farms and liquidity. We don't really carry much of an operational balance. We very much try to run as lean of a ship as we can and make sure that we are allocating assets as efficiently as we possibly can. Outside of that, circulating supply continues to go down. All we have is what's circulating and then what's tied up in the NFT contract. The protocol no longer owns any tokens, but that's been the case for a while now. I don't know that that's necessarily new news.
We usually own enough tokens at any given time to send out rewards and or burn them. Yeah. We don't hold a significant amount of tokens at any given point. If it's not sent for example, yesterday morning sent out the God NFT bonuses for everybody. So those got sent out yesterday morning. So I had to buy those off the open market in order to supply them. And then, as we go through, there are some mechanical things that we're going to talk about maybe next week. If everybody's around, we'll have some important updates for the organization overall next week. Just mechanically, we provide rewards for everybody, but we do that by extracting tokens from the open market and then redistributing them. But yeah, at any given point in time, the protocol usually owns less than $1,000 worth of tokens unless we're accumulating them to burn them. And that's just how it operates. Very lean. And like Michael said, 80+% of all the capital in the organization is allocated towards making that money make more money. Michael, you're almost ready to go, buddy.
Yeah, I'll do one more. Hit me with the number slide.
All right.
So one of the things we jumped into this month, and we're kind of slowly allocating towards, it was just an initial allocation. We wanted some exposure to Eigenlayer, just because we feel that it's going to be a rather significant narrative and play as soon as it goes live in June, and there's some work to be done before then. So we have some exposure directly on Eigenlayer with Swell ETH, as well as an allocation to EETH on EtherFi and RSETH on KelpDAO. Since the start of this month, we've actually put that RSETH and EETH to work on Pendle. Speaking of Pendle was actually one of the biggest earners this month, specifically because of the LRTs, that being liquid restaking tokens, EtherFi, KelpDAO, Renzo, Restake. A lot of them have plays on Pendle, and Pendle's TVL volume and activity has just been surging. And as a result, I think Pendle alone, was $7,300 in yield. And this goes back just to echo what we've said in prior months of this is why diversification is so important, because we may have months where an asset underperforms compared to the rest, and then the next month it could pull a pendulum and just blow away in terms of yield. But overall, very happy with the yield numbers. At the start of every month, Patrick and I kind of look at things, decide if we want to rebalance based on performance, if something gets too far ahead or falls too far behind. But overall, very happy with the numbers that we were seeing on the various assets. As you can see, overall total value of the fund saw a negative $1,400. But again, compared to other comparative assets, we're really happy that that's the only loss that we saw in terms of cumulative capital value. Held up very, very well considering the retracement we had from the highs at the start of the month.
Yeah, and that comes down to a couple of things that I want to highlight. So, altcoins bled a lot in January, but like we said, Max down 20%. A lot of altcoins were down anywhere from 15 to 30% in January. However, everything's paired against ETH, right? And ETH was flat. So this ability for us to manage loss in a downturn is huge for us when it comes to how we operate the organization overall. So by managing the ranges, by being proactive on our rebalances, we're able to minimize any fiat value loss that happens within the actual allocations, because we can go ahead and make changes in real time. Also, we did take trading allocation went from 28,000 to 100,000. Might seem a little jarring from a number standpoint, but essentially what we did is at the beginning of the month, we protected all of that fiat value by pulling it out of basically across the board. We extracted like 10% out of all of our positions and put it into stable coins into our trading allocation, simply because we wanted to protect against what we thought was coming, which is the sales and news events. That's what happened. But if we were to stay true to all of our positions and not make any changes, that negative 1,400 could have been negative 14,000 or more if we didn't make those adjustments in real time. So those are just ways for us to, how we make money is equally as important as how we stop ourselves from losing money. And so the decisions we made at the beginning of the month, when we had anticipated a downturn, protected us just as much, if not more, than how we managed our yield throughout the month of January.
Big brain moves.
Yep.
I have to duck out, but
Yeah.
Patrick's going to get into even more fun stuff with you guys.
Yeah. So as we were talking about, yeah, Michael, have a good day. Enjoy your imaginary work that you try to convince us you do.
Cheers, everyone. Catch you all soon.
Yeah, so this is the end of the month, DeFi Fund allocations. Like I said, we pushed a lot of it into the trading allocation, about 18% of the total fund. We're actually going to be pulling some of that back over this month, depending on how we feel about the market. So these are these temporary shifts in allocation that we can push, pull, and optimize as we move through the market sentiment. So this is really important for us to be able to kind of adjust in real time. Again, we do this full time. I was having a conversation with Crypto Penguin last week, and he asked me how much time do I spend on Discord and on charts and stuff. I go, probably 10 to 12 hours a day. And he's like, aren't you worried about getting burned out? I was like, I've been doing this for minimum 7 years, this like amount of workload when it comes to the space and charts and looking at investments. I was like, this is just my life now. And so as we move through this process, we can push and pull on these allocations to best maximize, like I said, not only our earning potential, but minimize our potential for loss. So all that stuff is part of this process. Operational balances. I just have to jump back and forth between Discord and the report now. because Michael's not here. Operational balances. This really just comes down to how the month started and ended when it came to how much we had in the accounts that weren't in the fund. So it's negative 3,600, but that's really just because we had more ETH and USDC sitting, or more Matic and USDC sitting in the accounts at the snapshot at the beginning of the month than the end of the month. So that's really the key metric here is the DeFi Fund metrics on the bottom. So again, this month we saw a contraction in the market, and so we had a total monthly P&L from a fiat standpoint of negative $5,000. It happens. Not every month is going to be up only. We're not always going to be green. So the months that we're not green, that number needs to be as small as possible. So for us, we earned $35,781 in yield, but we finished the month negative 5,000. Again, if it weren't for the things that we did throughout the month, that number could have been anywhere from negative 30 to negative 20,000 for the monthly P&L. So how we manage the drops equally as important as how we manage the rises. So all that is part of this process when it comes to taking care of the fund and you guys. Treasury allocations. This is our total treasury allocations from the fund, all of our operational balances, our seed LPs and farms. That one took a slightly bigger hit because of Matic. So our DeFi fund was essentially flat because Ethereum was flat and we managed our ranges, we managed our allocations. However, we always need to make sure that the protocol has enough liquidity for you guys. It's not a honeypot. Our ratios are 40% LP to market cap, 20% backing liquidity to market cap. So it's very healthy LP. We can't take that away if we think the market's dropping. We can shift it, which we did do in chunks. We can shift from Matic to STS Plus, which it protects a decent amount. But at the end of the day, the ultimate metric there is we need liquidity and we need to provide it for you guys to be able to move freely between your investments. And so the actual treasury allocations were affected by Matic dropping 20%. That's just kind of how it was. Also, we experienced a decent amount of selling from holders in January. Just the nature of people coming and going from investments. That's their prerogative. We have no issue with it. But again, we have to keep the liquidity there so people can make that choice and make it freely. And so there was about $29,000 drop in total treasury value. I think that's negative 6%. Again, we protected as much we could of the 80%, which is the DeFi fund. And then the other 20% is slightly more affected by Matic behavior. And so overall, it's not a major concern or red flag for us. It's just the market oscillating the way it usually does. So operational, this is right here. So negative 24,000 operational LP allocations. That's mostly Matic and Stasis being associated with Matic dropping 20% in the month of January. Stasis only dropped 15% against Matic's 20%. But again, if it's paired with Matic as its backing asset, those prices are 100% correlated, not considering transactions. So because of our buybacks and burns and pushing revenue to the market, we were able to basically offset a 25% price impact between Matic and Stasis, despite some people selling, despite the market dropping, etc. Protocol metrics. This is the last page. Ian at the bottom was very nice. It was very nice to add the Detroit Lions. Thank you, Lions, for helping burn tokens. So between the Michigan Wolverines winning the national championship and the Detroit Lions winning 2 playoff games, I went and burned $300,000 of my own tokens for the protocol, which is actually outside of these metrics. So those weren't actually added to this number. So we total Stasis tokens bought OTC in market was 1.8 million. That doesn't count the 300,000 that I personally burned. So this is a true number for how much we bought and we bought off the market in OTC. Up here at top right, we burned, absolute burn, 1.46 million tokens in the month of January. It's fantastic still. That's almost 2% of the circulating supply we burned in a month. It's a good number to hit. It's solid. It's sustainable. And then our circulating token supply dropped overall by a little over 700,000 tokens. And again, we talked about ratios that are important. So 6, 7, 8, and 9 here, LP to treasury ratio, LP to market cap ratio. These numbers are incredibly healthy. So number 9 and 10, LP to circulating market cap ratio, 39.4%, 19.7%. Anything above 10% is considered a healthy liquidity pool. It provides enough opportunity for individual holders to come and go without creating too much price impact. We have been consistently on that 40-20 range when it comes to our ratios. So that's really important. Other than that, that's basically it for the monthly report. I don't got much else for you guys. As always, we put wallets and stuff at the bottom with Ian's very beautiful graphics. I think that's it. Anybody have any questions? Hold on, let me look back in the chat now because I'm alone. Thanks a lot, Michael. And see if there's any questions. Norse God NFTs. Okay, so there's a couple questions about Norse God NFTs. So Norse Gods were 10 NFTs at the very beginning of the protocol. They were $2,500 each, and there's only 10 of them. So if somebody wants one, you have to convince one of the 10 people who own them to hand it over to you, but they're going to ask for a decent price tag. So those NFTs get your standard SVC weekly payouts that they all get. And then on top of that, we wanted the higher price tag for the rare NFTs, these God NFTs, to be backed by actual rewards from a tangible standpoint. So we pay out a monthly reward that's randomized between $50 and $100. The last few months, it's been right between, I think, $60 and $80, kind of in that range. So that's the TLDR on the God NFTs. Michael is off to Panhandle. That dude has a very large mortgage. He must be very good at panhandling if that's what he's doing. 80K in salaries. No, unfortunately not. To this day, I do not have a salary. And our total operating expenses, including salaries, are less than $6,000. So no 80K salaries for us. We have a small team, obviously, very efficient. We pay out enough to cover our needs. And then that is it. We are part of this bull run journey along with everybody else. Lions quarterback went to Berkeley. He's a smart dude. How many God NFTs are allowed to own per wallet? So when we sold them, it was one per wallet. There's 10 of them. So when we sold them, and to this day, there are 10 holders of these 10 NFTs. However, if someone were to go around and make ostentatious offers to the holders and collect 2, 3, 4, or 5 of them, there's nothing we can do about that. But I'm guessing you would have to pay a significant sum to get somebody to depart with them. Sunfire, there's no contract function that stops people. The only thing that we had was when we minted the NFTs, there was a 3 NFT cap per wallet for like the first 15 minutes, and then we just opened it up to whoever wanted them. And then Fiery Dev came in and bought them all anyway. So good on him. I had one other thing that I wanted to bring up before we closed up for the day. So let's talk about the client side. So we're still working on a lot of those pieces. So as we talked about last week, lawyer is working through our contract edits for our clients. We are finishing the process of setting up our AML KYC service through our lawyer. So because we don't plan on having hundreds upon hundreds of clients, we don't need to contract out to an official KYC service. Usually they will offer you a decent per customer price, but the setup cost is ridiculous. But that's because the upfront cost is high, but then if it's a scaling issue at that point, like if you plan on having 10,000 people or 1,000 people register through them, it becomes cost effective the higher that number gets. For us, we don't plan on having more than, say 30 or 50 clients at any given time. We want to stay small enough to be efficient with our staffing, with our operation. We don't want our overhead to get too bloated. So the nice thing is because we already have our organizational structure established, we already have our legal counsel and law firm relationship in place. They already have a structure for KYC and anti-money laundering regulation. So we're just going through that process now of getting the AML language written, getting the KYC infrastructure established. Barry is going through and having conversations with a couple potential clients and at least 2, you would say, middlemen to kind of get that process of disseminating information out into the world. So I expect to have much more updates on that side in February and March, being February today. And so what we're going through that process at the moment. Again, everything leads right back into the organization and the core protocol, which is you guys. And so that's the most important part is if we can build out client side the way we are, and those client fees come back directly or indirectly to the token and token holders in this organization. That's the plan. Next week, I will put out an announcement either next week or the week after. We will have a future of the organization update. So a lot of things we are going to be working on remixing, refining, and overall refreshing of the organization and how we operate, which I think is going to be nice because it will correct some things that we feel like we can do better, and it will streamline some things that we think we spend too much time on. And so this week or next week we'll have that call, we'll have that update and some information for everybody. But it's all good things. The changes that we end up making are going to lend themselves to the advancement of the organization. And so the nice thing is we don't have to change anything because anything's wrong. We are choosing to change things because we feel like we can do them better, or they're going to advance our mission in a way that is good for everybody. So, is there a target client minimum deposit? It's $100,000. So, the last thing we wanted to do was get in a position where we spent more of our time managing clients than managing money. And so we made a decision fairly early on that if we were going to put together a client side, it was going to be high value, low time commitment. So our time, we would rather spend 80 to 90% of our time managing the capital to earn revenue instead of managing clients. I've seen organizations get to the point where they become bloated with clients to the point where they spend all of their time running interference, doing client relations, doing client management, and then the thing that is supposed to be their business becomes secondary to client maintenance. And that's what we were trying to avoid. So we do have several people and organizations that are interested and have shown an initial interest, and a couple people that are already lined up to start that process of becoming clients. Now it's just a matter of we're formalizing it, we're building out the structure, and we're going to be able to essentially sell our strategy and earn a fee off of it to people that are ecstatic to be able to earn what we're earning. So again, we talked about last week, DeFi people would rather gamble. Like in general, most people that are in DeFi and in the space a long time, they don't really get that excited about 6 to 10% return a month. Usually, people are looking for a lottery ticket. They're looking for something that is going to 5 to 10x in the next month, whatever it might be. In general, if you're in this space, you have higher aspirations for your personal portfolio than 5 to 10% a month, which is totally fine. That's what we're here for as people who are well established in the space. However, there's a significant amount of capital that's in traditional finance that I call crypto curious, where they want to get involved, but they want to do it in a way where they're comfortable, where they're taken care of, where they feel safe. And so by targeting that crowd, it's the same crowd we talked about when we were launching in May, is how do we take that crypto curious crowd, meet them where they are, and then bring them along. And so this is the realization of that goal is there's a number of people and a lot of money out there that would be extremely interested in 5 to 8% a month. And those are the people that we're targeting. Those are the organizations that we're connecting with and networking with. And so that's something where $100,000 minimum, and then we grow from there. And so that's really important for us from a client minimum, just to make sure that our time is. I'm not from Southern California. I'm like born and raised most of my adult life in the Midwest. Come on now. Yes, I do call them crypto curious because they are. Whatever you want to insinuation you want to make there. Yeah, they are. They are people who they are driven by returns, and if you can offer them more returns than they could get in their traditional finance instruments and assets, we're gonna attract some attention. And so we're already having those conversations, and now it's just a matter of executing on them and kind of capitalizing on the opportunity. Let's see here. For real though, I'm happy with 2%. See, exactly. That's my point. Is if you come from a traditional finance background, 2-3% maybe a month if you're crazy lucky when it comes to your choices, when it comes to the different instruments that you're investing in. But over the long term, we have an opportunity to attract new capital, add to the space, and keep them happy and you guys happy all at the same time. So we're excited about that. That's all I have for the monthly update. Again, not every month's going to be green, but the red months we're going to make as small as possible. So we did $35,000 in yield for the month of January. That is 6.59%, right in line with our last 3 months of yield. So over the last 4 months, 6.97% is our average. The market contracted a little bit, but other than that, we are making moves that we are excited about when it comes to the health and future of the organization. 2024 is going to be really important for us. And so I think this first quarter, there's going to be a lot of moving parts. There's going to be a bit of, it's going to be a dynamic time for the organization. But trust me when I say this, every change we make is for the betterment of the organization. A lot of times in this space, if people change something, it's because something's wrong. For us, any changes we make, we're making them because we want to make it better. And so this is just part of that process. And as we move through the next quarter, we're going to start to realize some of those goals that we stated from the very beginning. And I think it's a really exciting time for us. Cool. All right. I'm going to wrap this up because if I don't stop talking, Sunfire is just going to keep talking. So thank you guys so much for coming to the monthly update. Wait. Oh, come on now. You do it. All right. I know this is an important question, but I'm going to let it happen. Go ahead. How fast can you type? What's the important question? Oh, geez. All right. Come on. Where's your improv skills at, bro? Come on. It's a quip. All right. I'm going to give some money away and then we can get out of here. So I'm going to give $10 in stasis away to 4 people. So those 4 people are, let's do Sea Lion, Imu, Fip, and Finesse. Let's do that. Finesse, Sea Lion, Imu, which I don't know if that's an insult or if that's just a funny name. And who was the 4th one? Oh God, I'm blanking. Fip. Oh geez, I'm just staring at his name right now. All right, cool. I'll have you guys open up a ticket. That's it for the monthly update. We'll have playback uploaded for anyone who missed the first part or all of it. As soon as Michael's done working, imaginary work, we'll have playback set up for everybody, and we'll drop in the DeFi Fund channel like we usually do. Until next week, I'll keep you guys abreast on what we're doing. So it'll be either next week or the week after. We'll have an important organizational kind of 2024 outlook in everything that we're working on. So I'll let you guys know if we're going to be doing that next week or the week after. But ultimately, all good things. And we thank you guys so much for being a part of this. It's a long process, but it's a good process. And I think we're going to have 2024 is going to be good. 2025 is going to be great. And we appreciate everybody sticking with us through this part of it. And we're going to build into the next section of the market. So thank you so much, everybody. Have a great weekend, and we'll talk to you next week.